Hi, I'm Anthony Diosdi. I'm a tax attorney in San Francisco with over 20 years experience in international and domestic tax planning and tax litigation. You can find me at sftaxcounsel.com. Hi, today we're talking about GILTI planning. So, when does somebody wind up receiving income that's classified as GILTI? Let's start off with that first before I kind of move into planning for GILTI. GILTI income is received from a controlled foreign corporation. And what is a controlled foreign corporation? A controlled foreign corporation is when you have a foreign entity that's classified as a corporation for US purposes. And that corporation itself is owned by a number of US shareholders that own at least 10% in the foreign corporation, and then when you add up the US shareholders in the aggregate, they wound up owning more than 50% ownership in the foreign corporation by vote or value. So whenever you have a US shareholder, the US shareholder is defined as a shareholder that owns more than 10% interest in the foreign corporation of a foreign corporation that is owned by more than 50% by vote or value of US shareholders, that US shareholder is going to be subject to a certain classification of income that, at least as of right now, is classified either as GILTI or subpart F income. Now, subpart F income is taxed similar to GILTI, but it is taxed somewhat differently. And for purposes of our discussion today, we're only going to be talking about GILTI. We'll make a future video discussing the taxation of subpart F income and how planning options are available for subpart F income. But for purposes of our discussion today, we're going to limit it to GILTI. All right. So when a US shareholder winds up receiving GILTI, if the US shareholder is an individual, that US shareholder will be taxed differently than if the shareholder is a domestic corporation. So let's start off first with when you have a US shareholder that's an individual that owns at least 10% interest in a foreign corporation, how are they taxed? Well, they're taxed on any distributions from the corporation, and the distributions itself are how its tax is determined on the E&P of the foreign corporation. And the distributions are taxed at ordinary rates, and they're taxed up to 37%. If the foreign corporation winds up paying taxes to a foreign government, the individual shareholder, absent planning, is not entitled to any type of offsets for foreign taxes that are paid. So it's a very punitive way of taxing a U.S. shareholder that happens to be an individual. Let's take a look and see how a U.S. shareholder that happens to be a U.S. corporation, when I say U.S. corporation, a U.S. C corporation, how that's taxed or how that entity is taxed. So if the U.S. shareholder is a U.S. corporation, it is taxed at a rate of up to 21%. Or I should say 21% from the distributions from the foreign corporation. Now, the corporate shareholder is also entitled to a deduction under Section 250 of the Internal Revenue Code of 50% of the distribution from the corporation. So, what that winds up doing is that it winds up bringing the effective tax rate for a distribution from a foreign corporation to a U.S. shareholder that's a corporation at a rate of only 10.5%. And that's, if you take a look at 50% of the 21% corporate tax rate, that's how you come up with 10.5%. In addition, the corporate shareholder is also entitled to a deduction for foreign taxes that are paid up to 80%, and that's this year, 2025, of up to 80% of the deemed paid taxes to a foreign government. So you're entitled to an 80% of the taxes that are paid to a foreign government. So it's quite possible that at least at the corporate level, you'd wind up having little or no taxes due. Now, next year, beginning in January 1st of 2026, the rules change a little bit. And the 250 deduction is no longer going to be 50% for next year. It's going to be 40%. But your tax credits, you're currently at the corporate rate is allowed at 80% of the taxes paid to a foreign government will increase next year to 90%. In essence, between the two, it's almost a wash. So corporate shareholders have a much better footing for tax purposes than individual shareholders. So there are a number of planning opportunities that individual shareholders of a foreign corporation can do to minimize the tax consequences associated with their ownership in a controlled foreign corporation. The first thing what a individual shareholder can do is they can contribute their shares into a domestic C corporation. By contributing their shares to the domestic C corporation, they can get the benefits of of what a C corporation has, which would mainly be a 21% tax rate, the 50% deduction under Section 250, and they could take the foreign tax credits as well, at least 80% this year and 90% next year. And the transaction itself can be done relatively simply because under Internal Revenue Code Section 351, an individual can go ahead and contribute their foreign shares into a domestic corporation, most likely without recognizing any tax consequences. Are there any complications involved in this? Yes, there are complications involved in it because whenever you're dealing with a C corporation, you have two layers of tax. So you'd be taxed if you contribute your shares to a C corporation, you would wind up being taxed on the foreign source income under the theories I just discussed, meaning that you would have a 50% deduction under Code Section 250, and you could take your foreign tax credits. So your first layer of tax, so to speak, it's possible that it would be very little or no taxes, at least at the corporate level. Now, there's a second layer of tax in the form of dividends, and those dividends itself will be taxed at ordinary rates. So you have two layers of taxes. Whenever you're doing this, you have to understand that whenever you're contributing your foreign shares to a domestic corporation, that there's going to be two layers of tax, and that has to be taken into consideration any type of planning before you go ahead and do. You should go ahead and model that out and see what the tax consequences would be of contributing foreign shares into a domestic company. The other issue, which could be a little bit messy if you're contributing foreign shares to a domestic corporation, is if you're dealing with a state, if you're residing in a state that has state taxes on a corporation, take that in consideration as well, because sometimes that could be a little bit messy for state tax purposes. And there's also a number of corporate formalities that have to be taken into consideration. You have to have annual meetings and so forth. So that can be a little bit bulky. Regardless, that is one way of planning to reduce the tax consequences associated with GILTI income from a controlled foreign corporation. Now, another way to mitigate an individual shareholder's income tax consequences associated with GILTI is by making a Section 962 election. What is a Section 962 election? Well, 962 election is a specific election that is made on the corporate shareholder's individual tax return. And that election, the way it works is that it treats the foreign income that is coming from the controlled foreign corporation as if it was owned by a U.S. C corporation. It's a little easier to do because by making the 962 election, you don't have to go ahead and start up a domestic corporation. You don't have to follow the formalities of it. So it's a little easier an aspect of actually going ahead and executing it. A 962 election, what is the benefits of it? If you make this election and you're taxed as a U.S. corporation holding shares of a foreign corporation, well, the benefits is that you get your 250 deduction. You get your deduction under Section 250. So first, you're taxed as a domestic corporation. So you're looking at a 21% tax rate. rather than up to a 37% tax rate. You're allowed that deduction under 250. So Section 250 of the Internal Revenue Code, which would bring potentially a marginal tax rate, at least in 2025, down to 10.5%. And you can also claim foreign tax credits. So your foreign tax credits, or should I say, you could take foreign tax credits up to 80% in 2025 of the amounts that you pay to a foreign government. So it's possible that you could have little or no income taxes associated with a distribution from the controlled foreign corporation. Now, there is complexities to making a 962 election. And the complexities are is that, keep in mind, you, by making this election, you are being taxed as a US corporation, meaning that you have to take into consideration the second layer of taxes as if you're receiving a dividend distribution from a US corporation. So the way that would wind up working is that you have a second layer of tax that, as a US shareholder, you'd be responsible for. So you have an initial layer of tax that you could wind up reducing potentially through the 250 deduction, through foreign tax credits, but then you have a second layer of tax at a future date. And there's a number of different things that come into consideration as to when you have to go ahead and recognize that second layer of tax, which is beyond the scope of our discussion today. But when you have that second layer of tax, you are taxed at an ordinary rate, and you are taxed at the entire distribution that you wind up receiving from the foreign corporation. But you do wind up getting credit for any taxes that you wind up paying to the IRS or that you wind up paying to a foreign government as well. So in certain circumstances, in the long run, you could wind up having a situation where, if you take in consideration your two layers of tax, it's significantly less than if you didn't make the election, the 962 election. However, there are some scenarios that you could actually wind up paying a higher amount of tax between these two layers of tax when you consider everything into its totality. So before you wind up making a 962 election, you should speak to a qualified tax professional who can model this for you and make a determination if this 962 election winds up working out in your favor in the long run, or if it's better to go ahead and do another option, such as taking your corporate shares and transfer them into a C corporation, or the other option we'll be talking about in a minute. There is another factor to consider when you make a 962 election, in that your tax returns are going to be far more complicated making a 962 election than if you've not made it. You have to go ahead and prepare mock corporate tax returns. You have to go ahead and prepare a number of returns associated with claiming a foreign tax credit. So these all have to kind of be taken into consideration. And finally, sometimes you could use a tax treaty to significantly reduce your income tax consequences with making a 962 election. So that should be also considered before making this election. Now, since we talked now about two options, one is utilizing a domestic corporation to hold your foreign stocks, or we also talked about making the 962 election. I'm going to talk about the final potential planning option to reduce your taxation associated with your foreign shares. So let's just say now you have shares in a foreign corporation that is subject to GILTI, and it's a controlled foreign corporation. The other planning option that can be done is to basically contribute the shares to a U.S. partnership or some type of flow-through entity like a partnership. And in Section 751 of the Internal Revenue Code, you can go ahead and contribute your shares of your foreign corporation, if you're an individual shareholder, to a partnership and not recognize any tax consequences. Now, by contributing your foreign stocks to a U.S. partnership, what winds up happening is that, A, you could take all of your foreign tax credits. You are no longer subject to a rate of only 80% or an extra 90%. You could take the entire foreign tax credit by placing it into a corporate structure, just a partnership structure. That is one benefit. However, the negative consequence to it is that you are basically winding up taking a distribution from the foreign corporation, and you are still taxed at that individual rate, which could be as high as 37%. So you cannot go ahead and take a deduction of the Internal Revenue Code, which is 250, to reduce it to 50% of the taxable income, and you are not taxed at that 21%. You're taxed at the 37%. So your rates are going to be higher, but at least you have the benefit of taking a foreign tax credit, and you have the benefit of taking the entire foreign tax credit by placing your foreign stocks into a partnership. The other benefit of placing your foreign stocks into a domestic partnership is simplicity. But when I say simplicity, there are no two layers of tax. In the other couple options that I just discussed, by making a 962 election and by placing your foreign stocks into a US C corporation, you are basically subject to two layers of tax. You're subject to your dividends, you're subject to the corporate layer of tax. So because of you take a look at both those layers of tax, it's possible that those two layers of tax could wind up actually being more than if you wind up going out and contributing your shares into a partnership. So as with anything else, modeling is crucial here. When you're talking about planning for distributions from a foreign corporation that is classified as guilty, there is no such thing as one size fits all. You always have to go ahead and take a look at the facts and circumstances of each case to determine what is the best planning option, or what is the best planning opportunity to reduce the tax consequences associated with this distribution. And the final benefit to going ahead and utilizing a partnership is just the simplicity of the tax return, meaning that your compliance costs are going to be less. Your compliance costs with making a 962 election or placing your foreign stocks into a C corporation, you're going to be preparing corporate returns, individual returns, doing a number of calculations for foreign tax credits, doing some markups under a code section called 78, where by placing it into a partnership, you are getting a more simplistic way of doing it. So your compliance costs wind up being reduced. So in any event, whenever you have an ownership in a foreign corporation and you are winding up receiving guilty distributions, it is extremely important to adequately plan for the distribution so you can reduce your US tax consequences and even global tax consequences associated with the ownership in the foreign corporation. And the planning should start early as possible, and there should be modeling as well. And also, the cost of compliance should be taken in consideration as well. I hope that you found this discussion to be helpful. Please keep in mind that this discussion is not meant to be an invitation for an attorney-client relationship. This is merely meant to be an informational discussion. Thank you very much.